Hello, and welcome to Quilter Cheviot's Markets Uncut podcast, your weekly insight into the topics and trends that we've been exploring for you here at Quilter Cheviot. I'm your host, Edward Lloyd, investment manager based in our London office, and this week I'm pleased to be joined by our regular podcast guest, Richard Carter, head of fixed interest research, and Matt Ennion, alternatives fund research analyst. Good morning to you both. Starting off, Richard. On the face of it, the employment numbers out of the US last week appear strong, with the ADP figures showing 497,000 jobs added, while non-farm payrolls also increased by 209,000. Should we take this as a sign that the US economy is still demonstrating resilience in the face of rising interest rates?
Yeah, good question. Absolutely, I think we should. I mean, the ADP number was a huge surprise. Actually, it was twice as much as I think the most optimistic economist expected, I guess in some ways it wasn't a surprise that didn't quite show up in the non-farm payrolls. But overall, the data out of the US has been pretty resilient. If you look at not just jobs but housing market data as well, there's certainly no immediate sign that this sort of oft talked about recession is on the cards anytime soon. So that basically means that the Fed's job is not done, and we've heard quite a few comments from Fed officials recently that although they took a pause at the last meeting, we can expect one or two more rate hikes to come as the year goes on. So yes, the US economy is proving to be very resilient.
I think it's also, it's funny taking those numbers because it still sort of splits opinion massively. You've got, like you said, the ADP numbers appeared so strong, and yet, after the non-farm payrolls, you still had people saying, "Oh, here's evidence of the recession coming," given that they've been sort of trending downwards. So it's like you said, people are still very split on what's going to happen out there. But I generally think, like you were just alluding to, it is showing sort of signs of resilience in the US economy. And I think the other thing is we're seeing that the wages are still picking up. So like you said, definitely Fed not done yet. But I think sort of moving on to the UK, we had some good news last week in that England won the third Ashes test, so the series remains alive. However, not such good news is that estimates are now seeing UK rates moving to 7% with the economic environment deteriorating. Could you see the economic environment deteriorating substantially in the UK if they go that high?
Yeah, I guess the Ashes is providing a good distraction from what's going on in the mortgage market at the moment. Yeah, I mean, you're right. There was a sort of report done by JP Morgan that suggested that interest rates might have to get to 7% to get inflation under control. Obviously, the headline writers sort of seized on the 7% number, didn't actually, probably read the rest of the report, which said that JP Morgan's base case was more about, I think, 5 3/4, which is where rates might end up at. So the headline didn't maybe tell the whole story. I mean, markets at the moment are pricing in about 6 1/4 interest rates by early next year. I think that will be more than enough to slow the economy and get inflation under control, because there is a real lag with these things, and we're only really starting to see the impact of all the rate hikes we've seen over the last year or so. So I don't think we'll need to get to 7%, but clearly if we did, I think that would be really, really bad news for the economy. And talking about the US, maybe a soft landing could be on the cards if the Fed does its job well. Well, I think a hard landing in the UK is possibly more likely than a soft landing if we have to go all the way to 7%.
Yeah, and I think also one of the divergence between the two is the sort of the rate sensitivity, and particularly the housing market in the UK. The duration of our mortgages tends to be much shorter than in the US, where they have sort of fixed term 30-year mortgages. But sort of on that, I guess one of the things that surprised me is that with rates moving to in the UK to sort of 5%, and and that you were saying pricing in now 6.5%. We haven't really seen the housing market crack that much. That said, it did fall in June. I mean, what do you see a correction or even a large correction, going to occur in this market?
Yeah, it's a good one. I mean, it's still, as I say, it's still relatively early days in the sense that there is a lag on the impact of interest rates. As you've said, you may have some people on variable rate, but there's an awful lot on fixed terms, and those take some time to roll off. I think it's about 1.2 million people this year whose fixed term rates are rolling off and I have to refix or move on to much higher rates. So it doesn't happen overnight. I would say with the housing market data, you are seeing reports that prices are starting to fall or have fallen, and also I would say if housing prices are flat, then in real terms, they're not going up anywhere near as much as inflation's been going up. So in real terms, they are effectively falling. But I think it's still early days, and as I say, if mortgage rates and interest rates keep going up, then clearly there are going to be potential implications for the housing market. I think also you have to think about other factors in terms of the construction industry. So interesting, I think the construction PMI we saw recently that activity in the sort of residential market really was very, very weak, sort of like levels during COVID lockdown. So it's not just the impact on mortgage holders. You also start to think that house builders might be reluctant to start new projects if they're worried about where mortgage rates are going. So these things do take some time to unfold, but yeah, clearly it's a concern.
Yeah, and I saw a rather brilliant, if not depressing, chart the other day, which was just showing, the effect of interest rates on mortgages, and they were showing, the fact that, mortgage payments for a £500,000 sort of property with a 25% deposit would now be sort of £2,000 a month, and previously you'd have been able to afford, at lower rates, albeit a house of £800,000. With those monthly payments. So it just shows you how sort of how impacted the market has been in terms of affordability by these higher rates. And yeah, as you were saying, there's not been the full correction in house prices, even if they are sort of coming down a little bit. But staying on the sort of topic of the UK, one thing we sort of continue to discuss regularly is whether the UK is an outlier versus sort of other countries in the inflationary dynamics that it's experiencing. Which side of the fence do you fall on this argument?
I'm not so sure. I mean, it's not like, I mean, headline inflation's coming down in other countries maybe a bit quicker than here, but they've still got the same problem in the fact that core inflation is the problem, and you've got high wage growth, inflation in the service sector. So in that regard, we're not much different. I would just say that potentially there's more of a lag here, and we are kind of suffering from a few other issues, particularly around the tightness of the labour market. So unlike in other countries, there's still quite a lot of long-term sickness and economically inactive people who haven't come back to the labour force post-COVID. So that's not helping. We're also quite reliant on imported food and energy. So there are some senses that the UK is an outlier, but I think over time that will sort of wash out. And as I say, we are facing problems with core inflation just as Europe is, just as the US is.
Yeah, brilliant. I definitely think totally agree with everything you said, and really that challenge for central banks going forward now is going to be sort of focusing on core inflation and trying to get that back to a number sort of nearer 2%. But aside from sort of inflation and interest rates, Matt, turning to you, these impacts have also sort of of higher interest rates and inflation have hurt the infrastructure space, and the discounts we've seen on some of those trusts have widened pretty significantly. Do you believe that they continue? Do you believe they now look good value in this environment?
Yeah, it's a good question. Again, obviously in the last few weeks, we've seen the share prices of infrastructure assets and renewable assets, trade off to anywhere between sort of 10 and 20% in what is normally a pretty stable asset class. And as you sort of alluded to, these trusts have historically traded on premiums. The share price have traded on premiums to their net asset value, where today they're on anything up to a sort of 20% discount. So it would certainly appear at the headline level that there's some value there, and I think that's probably right. I think, with interest rates rising, all assets have had to reprice to a certain extent. So it's fair that infrastructure similarly has repriced to a certain extent. But with a yield of sort of 7% ish today, give or take, depending on which investment company you look at in this space, and discounts at 20%, and it does feel like the price moves have been overdone. The selling has been pretty indiscriminate, and if you think about what these trusts offer, they're pretty stable assets in defensive sort of areas of the market, very much long-term contracts. So the income and the cash flow that these companies generate are sort of 20, 30 years of time horizons generally. Most of them have got some good strong inflation linkage as well, so there's quite a bit of predictability there. And with that type of predictability, you would expect the companies to trade somewhere near NAV, given that. So given we're on such wide discounts, I think there's some value there. And if you look at the sort of first quarter NAV announcements, they were pretty solid. Nothing's really changed. Clearly some of the sensitivities around sort of interest rates, power price and things like that sort of change NAVs to a small extent, but they do offset some of the interest rate rises that we've seen, certainly the inflation linkage. So I think overall, these are decent, defensive, good quality assets. I think the one factor that makes it difficult to assess whether we've got absolutely good value today is just around the macro that you've just been talking about, really. And there's so much uncertainty around where interest rates will get to, where is inflation and how long will it persist. I think that makes it very difficult. And if we do see, rates go up to sort of 6.5, 7, as you say, and inflation's be pretty sticky, then, I wouldn't be surprised if we saw some more volatility in this sector going forward. But as we stand today, for long-term investors, I think there is some value there at present.
Oh, thanks, Matt. And I guess that sort of leads very nicely onto my next question, which is, given where risk-free rates have got to, 5% currently, but like you were alluding to just then, the potential to go higher to 6 or even 7. Do you think infrastructure in that environment? Do you think infrastructure should continue to play a role in portfolios?
Yeah, I think so. I think that the reason we invest in infrastructure and other assets is around diversification, really, and diversification of returns away from equity markets ultimately, which tend to be a bias within portfolios. So I don't think, as I sort of mentioned, that the characteristics have changed within this sector. I think you've got some good quality, unique assets in many of these portfolios, defensive assets, high quality counterparties. Many of the sort of cash flows are backed by governments or certainly regulated cash flows and subsidies. So you've got some good, strong, long-term, some cash flows there. As I mentioned, inflation linkage is pretty key in this type of environment. And I think ultimately, the cash flows, unlike sort of government bonds or bonds generally, they don't grow, where within this asset class, income does grow. And we invest with managers that can sort of actively manage their assets and generate, strong growth in their cash flows and also in their asset value. So there's growth in there as well. So I think, the type of assets that we've sort of talked about there being very defensive, are very differentiated and offer diversification within portfolios. So I think that's pretty key. And I think the other factor just to mention is the structural trends behind the infrastructure sector generally. There's a lot of new regulation going through in both the US and Europe, committing substantial amounts of capital, billions of dollars, pounds into the sector. So there's a lot of investment going into this space. Clearly you've got the energy transition, where renewable assets, there's a high demand for renewable assets, I should say. An aging infrastructure across Western economies that need investment. Digitalization. A number of infrastructure funds will invest in things like data centers and what have you, where there's huge amounts of investment going in, and ultimately broad population growth as well. So there's big trends behind this sector as well that can sort of certainly help returns going forward. So I think infrastructure remains a good stable asset class, but like other asset classes, it's been sort of impacted by the rate environment that we're seeing in the shorter term. But certainly long term, I think it should still continue to be a mainstay of the sort of alternative portion of a client's portfolio.
Brilliant. Thank you, Matt. And to totally agree with what you said. The long-term sort of structural trends in the space, coupled with the sort of inflation linkage and in some of the cash flow, certainly makes the discounts which they trade on today seem slightly surprising. And we're definitely continuing to allocate to that space in our portfolios, and and also you were saying keeping it there for diversification purposes too. But anyway, thank you very much, Richard and Matt, for those great insights, and to all of you for listening. Did you enjoy our discussion on the podcast today? We'd love to hear from our listeners. So please review the show now, wherever you're listening, and share it on your socials and tag us at Quilter Cheviot. Remember, so you don't miss future episodes, be sure to hit the follow button on whichever streaming platform you're listening on, or by following #QC Weekly Comment on LinkedIn. We will be back next week. In the meantime, head over to our website, www.quiltercheviot.com, where you can read the accompanying market overview, as well as subscribe to our weekly comment newsletter. You can stay up to date with our thoughts on markets, news, industry insights, and our upcoming events and webinars on our website or on our social media pages. Finally, do you have any questions you'd like to ask one of our experts for our next podcast? Simply ask them via the weekly comments page on our website. We'd love to hear your questions. And that's it for today. So thank you, Richard and Matt, for your time, and to all of you for listening. See you next time.